Dividend investors, bonjour. Today we are looking at 3 ways to avoid dividend cutters. I mean, dividend cuts are terrible in your portfolio. They hurt your revenue, they cripple your retirement plan, and you lose capital on top of that. So you do not want to have those dividend cutters, right? And the problem right now is with higher interest rates and central banks that are all in on killing inflation, well, chances are we're gonna see a lot more coming up. So today we're going to share with you 3 ways to avoid keeping those dividend cutters or selling them right before they die. Dividend growth investors, bonjour. My name is Mike Leroux and I'm the founder of Dividend Stocks Rocks. I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. So make sure you subscribe, you give me a thumbs up, and here we go with my 3 tricks. The first one will sound very counterintuitive, but it's to trust the market. I know a lot of people say, well, Mike, the market is crazy. You should not, it's just like a bipolar person going up and going down and being filled with emotion. But you know what? There's one thing the market can identify quickly, and it's opportunities. And that money moves very fast. And whenever you see a stock showing a high yield, it's a red flag. It's not all high yield stocks that are bad. And actually in the next 2 weeks, I'm going to share with you 5% yielders that are safe. But today we're going to talk about all of those that shows more than 5% yield and may cut their dividend. So here's 2 examples here. So you have H&R, REIT, and AT&T, 2 famous companies in Canada and in the US, and they were loved for their yield. A lot of people were saying, well, Mike, I invest in those for the yield because the yield is amazing, the dividend, it doesn't grow that much, but it doesn't matter because the yield, and it was just a big focus. Well, now you can see what's happening when you keep a dividend cutter in your portfolio. So H&R, AT&T, you can see that over the past 5 years, they lost 35% and 50% of their stock price. In terms of dividend, they were cut by almost 50% each. So you're losing 30 to 50% of your capital and then 45 to 55% of your income. And then if you add up everything, that's because you're gonna say, yeah, but Mike, if you combine the dividend plus the stock price, it doesn't matter. Look at the total return. And you are right. Let's look at the total return. Well, there you go. Total return price includes stock price variation plus all the dividend payments being reinvested in that stock. And unfortunately, even AT&T is down by 2%, and H&R, I'd rather not even talk about it. So do you really want to keep those high yielders? Then you have to be very careful. So that's the first red flag where you should do a lot more research on those. Look at the balance sheet, look at the payout ratio, look at the dividend triangle. Make sure that you do not fall into a sexy narrative telling you how the great thing's gonna happen in the future. Look at the numbers, because the numbers is gonna tell you one single truth: is your dividend is safe or not. My second trick to avoid dividend cutters is to sell stocks that stops increasing their dividend. Actually, between you and me, if a company keeps the same dividend for more than a year, you already suffered from a dividend cut. So it's already too late to get that dividend cutters out of your portfolio, because if your income is the same for the next 5 years, well, then inflation, I'm pretty sure that now you know what inflation means, because now we feel it in our pockets and our budget has been hurt with that, especially if you go to the grocery store, right? So if your food budget is always the same thing today and in 5 years from now, do you really think that you can afford that filet mignon anymore? I don't think so. And here's the thing. So whenever a company stops increasing its dividend, it's a huge red flag. Most of the time it's gonna happen with the first red flag, that is a high yield plus an absence of dividend growth. And as you can see here on this graph with Common REIT, with Chorus Entertainment, with Macerich, whenever you see, first you will see a slowdown in the dividend increases and then a plateau. What happened after the plateau? Well, an absence of dividend growth is the first steps toward a dividend cut. most of the time the story ends up the same. And as you can see there, you lose income and you lose capital. So even if you want to turn around and invest in something else, you're going to have less money in your portfolio. You're gonna generate less income, and it's almost impossible to recover from a dividend cutter. So long story short, if you have a high yield and you have an absence of dividend growth, you start panicking. I mean, it's really time now that you sit down and you do a thorough research on that stock, because chances are you're not going to be able to retire on that juicy yield that you love so much. Last but not the least, actually pretty much the most important one, is a stock that would have a weak dividend triangle. So I decided to take an example of a company that didn't cut their dividend yet, but seriously, that would not surprise me in the next 2 years if Transcontinental cuts its dividend. As you can see, the revenues are not growing. So it's a business that is trying to transform its entire model from a printing media business all the way to packaging. So they made a big acquisition and they're trying to make that transition. You can see on the numbers, not exactly a smooth transition, and it's really hard for any businesses to shift their business model, and it's understandable. But in the meantime, struggling in revenue, declining earnings, no dividend growth since COVID, and guess what? A high yield. So what's going to happen with Transcontinental? I mean, why in the world this company would continue to increase its dividend if earnings are going down? It's going to be very hard, right? And you can see that those fundamentals are being translated in the stock price, where the stock used to trade above 30 bucks and now it trades around $13, $14, $15. So what's going to happen next after all of that? Well, if the business is not able to make that shift around, which is definitely struggling right now, well, chances are the dividend cut is coming. Even then, even if there's no dividend cut, well, you already suffered one, because if you had the same budget in 2020 and today, well, then you're not eating the same thing. And I'm sure I'm going to go back to that filet mignon. I don't think you're going to eating that filet mignon any longer. I think that to avoid dividend cutters, the best solution is offense, because offense is the best defense. You're better off selecting companies with strong revenue growth, strong earnings growth, and strong dividend growth, because a dividend that just has been increased is a lot safer than the one that has been stagnant for the past 3 years. You're going to agree with me. And then if you look at the balance sheet, you look at the payout ratios and all the other metrics, you're going to pretty much identify a trend for a great and thriving companies that is a dividend growers, and a mature struggling business that do not increase its dividend and could become a potential dividend cutter. To find those stocks, I have created the Rockstar list that is being updated monthly. So you can sign up to the newsletter in the link description below. You're going to receive the latest edition of the Rockstar list, and every single month we update that Excel spreadsheet. It's the results of the research that we do on the Dividend Stocks Rock Stock Screener. We have like a lot more information on the website, but I'm giving you this Rockstar list for free. This is definitely not a buy or sell recommendation, but it's a good starting point for your research to find great companies. So again, link description below. Let me know about your tricks to avoid dividend cutters. I'm very curious about that, so I'll see you in the comments on this. And next week, next Thursday, we're gonna have another video, and until then, don't forget to stay invested.